program. I'm Jackie DeAngelis. Joining me today on the floor of the CME, Jim Urio and Jeff Kilberg. Gentlemen, welcome. Lots to talk about today. We're going to discuss bonds. We're going to talk about silver. But first, let's dig into the markets. Guys, we are seeing the markets move a little bit higher today. Could be a positive read on data. It could be optimism over the situation in Greece, although it seems that the talks with the IMF might have stalled a little bit. That's why we're off session highs at the moment. Jim Urio, let me ask you your take. Why do you think we're higher today? And do you think that, we're poised to take another leg higher from here?
Age before beauty.
I do think we're poised to take another leg here, and I hate even saying this word because I know someone's got a shot glass in front of them and they have to drink when I say trading range. But this has been a long trading range. And when we were at the lows 2 days ago and the support was right where the map said it would be, the market was faced with a decision. Do we have enough to worry about to break low and go beneath it? And we didn't. So the reality of it is then the shorts get squeezed out. We shoot higher quickly. Now we're smack dab in the middle of the range. We're going to try the upper end. I think eventually we're going to break out after the Fed convinces us that, one, yes, they're going to go in September, and that, two, that's going to be couched with a lot of dovish talk, meaning we're going to sit back and wait after that.
I think Jimmy's overcomplicated a little bit. We are stuck in a range, but I think the simplistic, to use a hockey analogy here, as the Blackhawks are getting back tied up 2-2 here, it seems like the market's on ice. We're just kind of going left, going right. It's so much uncertainty going into next week.
My drinking analogy was way better than his hockey.
All right, we'll see what the Twitterverse says. Right. But nonetheless, the market just seems to be sliding left, sliding right, so there's no real certainty. So I think we are looking next week for something out of yellow, just something to grab onto, Jackie, because right now we don't know if we're going lower or higher.
Jeff, it sounds like wishful thinking because nobody is really expecting to hear anything new from her. Nobody's expecting to hear that we're going to have a rate hike now. Everybody has it on the table for September. So some people are saying that the Fed will be a non-event next week.
Well, I disagree, Jackie. I think they're going to be more of the same, but that one little twist of language, if they insinuate September and then they may take a pause after, we're just looking for something concrete to digest.
I agree with Jeff, and I think the one thing we're going to pay most attention to is how strongly they hammer home the point that this might be just a one-time 25 basis point thing and there's nothing for anybody to worry about. If they can convince the market of that, I think it's a good thing for the market.
Okay, well, meantime, let's bring in our guest to talk about the markets as well. He's going to take a look from a technical perspective. We're talking to Matt Malley from Miller Tabak. Matt, great to have you on the program.
Great to be here.
Every technician I've had on recently agrees with the gentleman, if you heard the conversation before, that the technical setup right now is to the upside. Do you agree with that? And if so, why?
Well, it's, as we just mentioned, excuse me, as you guys were just mentioning, we got right down to that 100-day moving average. It's amazing how many times we've touched that since late December. And every time we touch it, we may dip slightly below it, and then we rally. The problem is when we rally and we break to new highs, which we've done several times, each time it's only a slight break of 1% or so. Although it's kind of an upward sloping channel there, my concern is that we haven't been able to break out in a significant way.
Do you think, do you agree with the traders that were speaking before you that the Fed meeting next week is an opportunity for this market to potentially get a leg up?
That it should be. I mean, every time they seem to speak, at least leading into those meetings, the market tends to rally a little bit. The one thing is, can it break above 2150? That's kind of the magic number, 1% above the old high. Each time that's been a big resistance level. So if we can break above that, that'll be positive. But with interest rates moving higher and economic growth being pretty mediocre, it's going to be tough to do that, I'm afraid.
Well, and that's my follow-up question. What are you putting your money on, for a break higher or lower at this point?
I think with you have basically high valuations, and that's tougher to maintain when you have interest rates moving higher. And we also have GDP and earnings growth that are flat. I mean, they're doing a little bit better, but they're not very good. So I actually think the move with the eventual break will be to the downside.
Target on the S&P 500. Well, we're mid-year now. Let's talk about the end of the year.
Well, I think let me put it this way. I think the near-term risks are greater than the near-term potential. So in other words, I think the upside could be 1 to 3%, where the downside is 7 to 10%. Although by year-end, we'll probably recover from a more meaningful pullback.
Okay, Matt, thank you so much for calling in. Really appreciate your time.
No problem.
We will check back in with you soon. Meantime, let's go straight to the traders. Jim, what do you think of what Matt has to say? I know that you look at the charts very closely as well.
No doubt. And what I tend to think is over a long term, when a market is caught in a range like this, it generally has breaks out to the same direction that it arrived at this place, and that's why I believe that the breakout's going to be the upside. I'm not putting all in on the upside. I'm going to wait till it breaks out before I do that. But within the range, I think that there's trading opportunities. Like right now, I think at the very least we test the upside of the trading range, and that's why I think if you can get the SEP E-mini, which is we've rolled to the SEP contract now at 21 even, which is right around there now, with a target of 21.18 on the upside. It's a good trade. If it trades below 20.91, let's say, we wash it out.
All right, let me just call a timeout here, Jackie. A quick, maybe
Please
20-second
do.
timeout. And I disagree. And why do I
Surprise,
disagree?
surprise.
Because unequivocally for the last 75 months, every time we've seen a dip, you buy it, you're there. You're making money. But right now, what is different, Jackie? It's the 10-year. The yield right now I'm looking above 2.42%.
Well, and that's what Matt's pointing to as well.
So I think right now I'm a little, I've seen some technical damage in the bond market. We saw that this morning, the 10-year. So right now I fear that there's a little bit of anxiety represented in, let me finish,
Okay, I'm letting you
please.
finish. I'm letting you finish. Okay.
The
Yeah.
Treasury market, if it goes up to 250, that's going to make people a little bit skittish in the stock markets, and we see
Here's
some sellers.
what I think is fascinating about this argument, and I don't 100% disagree. I think it's a concern right now to see 250 10-year yields. And I think the stock market is looking at that, trying to figure out how they interpret it. But my thinking is this. When rates were 1.6, let's say, you bought stocks because of the relative value, because of the yield potential. But now you're going to have to think of this, is that if people are getting out of bunds and people are getting out of bonds, there's a lot of money that's coming out. And when the dust settles, provided that none of those moves are too aggressive, that money then comes
Okay.
back to
It's a great
stock.
Can I
point.
just
And
interject for a moment?
The digestion, yes.
Sure.
I think you brought up a good point when you talk about the bund and the impact that it's having on our markets as well. Let's go back to the Greece situation for a moment, Jim. Say we do have a solution. I know this has kind of been a never-ending story here, but does that poise us to go higher?
Which he loves. He loves the drama.
Yeah, I love the notion of a solution. Because reality, what we're talking about is can they sufficiently paper over it and
Right.
kick it down the can? That's two metaphors in one sentence, by the way.
Bam.
Bam. Yes, I think they can paper over it and kick it down the road, but I do think that market position is going to dictate the bunds move as much as the reality of the story. And still, people are long bunds. So I think that move still has legs. And even look, today's big bounce back in the bunds did not take it over any sort of critical technical levels. So I think it's all in the framework of higher German. I think the deflation trade is essentially dead, and market position is going to dictate higher rates in bunds, which means higher rates in U.S. as well.
All right, let's go ahead and put a pin in it there, get the bottom line on this trade before we move on. Jim is buying the S&P E-mini at 2,100. He's targeting a move up to 21.18. Since each point is worth $50, he's risking $450 to make $900. And just to hit the point home, Jeff does not agree with his trade.